Now, turning over to the Fireside Chat. Moderating the Fireside Chat will be Tom Wipf from Morgan Stanley. Tom is responsible for Morgan Stanley's transition efforts to alternative reference rates to replace LIBOR. Tom has also served as chair to a number of industry committees, including the Alternative Reference Rates Committee, sponsored by the Federal Reserve Board, the CFTC's Market Risk Advisory Committee Interest Rate Benchmark Reform Subcommittee, and the Treasury Market Practices Group. Tom currently serves on the board of directors of ISDA. And now I'll turn it over to Tom.
Thank you very much, Rania. And as we heard earlier from President Williams, we are now reaching a milestone of 459 days until the end of LIBOR. So it's my pleasure to continue the conversation with Chairman of the Commodities Futures Trading Commission, Heath Tarbert. Chairman Tarbert was nominated and confirmed as chairman of the CFTC earlier this year. In addition to serving as a voting member of the Financial Stability Oversight Council and as a member of the President's Working Group on Financial Markets, Chairman Tarbert brings extensive experience in financial services law to his position. Prior to joining the CFTC, Chairman Tarbert served as Assistant Secretary for International Markets and subsequently as Acting Undersecretary for International Affairs at the U.S. Department of Treasury. Chairman Tarbert earned his bachelor's degree from Mount St. Mary's University, his JD and SJD from the University of Pennsylvania, and his doctorate in philosophy from Oxford University. It is my pleasure to pass this on to you, Chairman Tarbert, and to hopefully you to provide a few opening remarks as we enter this 15-month or 459 days till we can no longer rely on LIBOR. So, Chairman Tarbert, if you will.
Well, thank you so very much. It's obviously great to be back here, at least virtually back at the New York Fed. This is one of my favorite conferences of the year. And I'm grateful for Tom to have you, such a leader in industry, interviewing me or at least having this chat with me on a subject that I think many people out there sort of generally understand, but view it as somewhat arcane. And today I thought it may be most useful if we just start out with the big picture. And in fact, it is a big picture. So what's the deal with this LIBOR transition? Well, number one, LIBOR is going to go away at the end of 2021. How important is it? Well, there right now are 200 trillion financial contracts that are priced according to LIBOR. 200 trillion with a T. So what does that mean? That means 10 times the U.S. GDP. That means 10 times the S&P 500. So there are two aspects to the LIBOR transition that I really want to hammer home. And the first is this. When you are talking about $200 trillion of financial contracts that are priced according to LIBOR, and LIBOR may go away, if there is no alternative for that, ladies and gentlemen, we are staring down the barrel of what could be a financial Chernobyl. That's how big of a deal it is. That's how big of a deal it is. Now, that said, there's good news. I bring you bearing good news today, and that's that we've done everything we can to potentially to mitigate that risk, that there will be a situation where all of a sudden we'll have $200 trillion worth of exposures that will no longer be able to actually be calculated and valued. So that is the good news, and we're going to talk a little bit about that going forward. The other aspect to LIBOR transition is this, is that LIBOR itself is I think in the views of many market participants, and I'd love to hear your views on this, Tom, is sort of diminished in its credibility. So let me give you an example. I mentioned $200 trillion of assets based upon LIBOR. But the amount of inputs to LIBOR as a reference rate has actually continued to diminish, such that now we're at a level of roughly $500 million worth of assets that are actually priced on LIBOR and make part of the benchmark. So I was thinking, well, these are big numbers. How do I explain this to everyone? And I thought, well, what's the big news event that everyone is talking about? Tonight we have the first debate, the U.S. presidential election. So the best analogy I could come up with is 200 trillion derivatives assets. Let's say we're talking about 200 million American voters. and 200 million American voters, rather than having a national election, we decide we're just going to have 500,000 people vote. We're just going to have, for example, the city of Kansas City decide the entire presidential election. That, in many ways, is emblematic of the relationship between where we are with LIBOR and the underlying market structure that is pricing that index. So that's another issue that's important. And I want to highlight that we actually saw this play out during the recent crisis. During the recent crisis, there were many days in which there weren't actually LIBOR transactions. And so we had this $200 trillion of financial contracts sitting out there. And instead of actually getting market data, we got, quote unquote, expert judgment. And so, again, I think those are the two big concerns. First of all, the big systemic cliff edge risk, which I just call the potential financial Chernobyl. Again, I think we've reduced the risk there. But there's also this transition risk as well, in that LIBOR is becoming more and more, I think, of concern as a useful rate.
Well, thank you very much, Chairman. I think what we're seeing here is, the work that's been taking place in that reduction. I think you've really, articulated, I think as we can, the amount of work that has to be done by the private sector and the official sector. And I think over the last several months, it's been pretty clear that we have heard across the official sector, a clarity and a directness of message, very much like the message you're giving us today, that has really laid out the path. And I think, focused the markets in a way, even during these periods and the challenges of COVID-19, to be able to actually move that work forward. And I know that when we think about LIBOR and we think about the general work that's happening at the official sector and the guidance that have happened from all the way from finance ministers to central banks to all the groups that have been around this work, what we're seeing is, I guess the question for you would be, what role would the CFTC play in this, and how can you best give us a view on sort of what work has happened at the Commission?
Yeah, well, thank you. Well, many people think about LIBOR, and of course they think, well, that's a bank rate. What in the world does the CFTC have to do with all of this? Well, our agency actually forms part of what's called the Troika, between the Federal Reserve, which is both the board as well as the Federal Reserve Bank of New York, and the UK FCA. Together, we have shared responsibility. Our responsibility is actually pretty simple, and it has two components. Number one, LIBOR is a commodity under the Commodity Exchange Act. And so therefore we have regulation on that basis. But the second, more practical aspect of it is, out of that 200 trillion of financial contracts, 95% of them are derivatives. So that's where we've come into play. So that is the role that the CFTC plays. But I want to make an important point here, and that's that unlike many other public policy problems that we've confronted in the past, this is really an area that I've seen in my career in financial regulation, both in the private sector and the public sector, are really coming together of the private sector and the CFTC and the other members of the official sector to work this out and figure out a solution. So I want to commend this as really a unique set of circumstances where we've worked well together.
Thank you. And I think part of that work, Chairman, has been really focused on potential things that could serve as impediments to this transition. And in many ways, I think when this work began, all those years ago, and now we stand here again with 15 months to the potential for the end of LIBOR, there have been things identified along the way that potentially would discourage market participants from actually moving forward with either, protocols or fallbacks or transitioning or actually converting out of trades and moving more quickly from LIBOR to Sulfur. When we think about, rulemaking broadly and things that can actually happen and removing impediments, what role do you see the CFTC playing? I know there's been a lot happening on that front.
Yes, so we are almost there in fully creating a regulatory relief package that basically allows a smooth transition. And there are a lot of technical aspects to it, but if I could just summarize it at a high level, it's basically this. There would be no adverse regulatory consequences from you taking an older contract and converting it to an alternative reference rate. And so that's essentially what we've done. And so what does that mean? Well, it means there are certain requirements regarding clearing, for example. There are certain requirements regarding SEP. trading on various platforms. And the concern is of course, if you take a derivative that originally that is currently on LIBOR and you convert it, that could arguably make it a new derivative. And then this panoply of new regulations and rules could apply to it. So what we've done is basically said, what you're going to do is just convert something that's old, LIBOR-based, into something that's new, based on Sulfur or an alternative reference rate. There won't be any adverse regulatory consequences. And so that's the big picture. And I want to commend the ARC in particular for working with us to think through those issues. And maybe, Tom, if I could just turn it to you, because, again, we've been doing a lot at the CFTC, but you've been doing an incredible amount, both at the ARC, but then also as leading the subcommittee that was mentioned in your bio. And I wonder if you could just tell the people watching kind of the role the private sector has played today.
Yeah, well, thank you very much. I think what we've learned along the way here is that as we really go from product by product across this, each product has its own set of challenges. And as you mentioned, with a vast majority of notionals and risk sitting in the derivatives market, I think that, the role the CFTC has played through their Market Risk Advisory Committee and the subcommittee that was convened in July of 2018, I think it was very clear that, again, each sort of player in the official sector has a different role. And I think what we learned here was if we could bring, using the Market Risk Advisory Committee, which is a very important standing committee to the Commission, and then bringing market participants together and really addressing these issues, we found that this would really, for the derivatives market as it relates to clearing, is the protocols and things of that nature, were able to bring us, I think, an opportunity to deliver on that private sector side, or where we're seeing. So fairly quickly, we brought together the subcommittee. We've reported back to the MREC and the Commission on several occasions, but we were able to put together a plain English disclosure, because when we think about this whole process of education and notification, but letting people, and we think about, the $200 trillion LIBOR that you discussed, where this goes across consumer products where we know we need to hold a very highest standard of care, and across the institutional markets, making sure that people understand what this means, so people are not surprised, and we can reduce the risk to that event. So I think when we talk about this, we've seen work from the Chief Economist's Office of the CFTC that gave us a view on sort of legacy swaps and analysis. And then back in December 19, the MREC charged our subcommittee, the Interest Rate Reform Subcommittee, with coming up with reviewing how the clearinghouses would switch from Fed funds to Sulfur, which is going to be happening in the month of October. So after a lot of months of preparation, a lot of work with your team at the CFTC and members of the MRAC, was able to run a tabletop. And I think this was one of the key accomplishments we saw there, which was from a perspective of being able to bring market participants together, do a dry run, if you will, of the events that we're going to expect between both clearinghouses. October, we were able to uncover, several things that we thought needed more work, much like having FCMs do, enhanced disclosure and education, making sure that conversions, which will be hugely important milestones into the transition, because we will begin to see, Sulfur liquidity out the curve where we had not seen it before, because market participants are going to be presented with compensating basis swaps to take us through it. So that piece of the puzzle. And again, we thank the CFTC for providing us the venue and the content and the support to actually get that done. So that was a real big piece of work, and I commend all the participants, both on the subcommittee and the MRAC, and obviously the support of the Commission for us to be able to get that work over the line. We look forward to that. That lives on the CFTC website, as you know, and people should draw on that as we approach that important milestone.
Terrific. And speaking of milestones, I think the question that I would have if I was watching our Fireside Chat is, okay, next 30 days, what should we be on the lookout for? And I would say from the CFTC perspective, there are two big things. And they're actually easy to remember, because one deals with the uncleared swaps market, the other deals with the cleared derivative space. On the uncleared side, we are very close to having ISDA get final approval for the protocol that would allow the contracts to go ahead and switch from LIBOR to an alternative reference rate. I think at this point, and it should be very, very soon, So the protocols have been vetted. They've been agreed to, at least at a conceptual level, so they could be written in. They're awaiting review by the Department of Justice because obviously there are antitrust considerations. But once that is out there, then I think it's really incumbent upon the private sector to go ahead and start adopting those protocols so that switchover can occur. At the same time, when we look at the cleared markets, we are doing a one-step switchover from sort of a floating rate base that used to be LIBOR, now it's federal funds, but we're switching over to Sulfur at some of our big clearing houses, particularly CME and LCH, and that is going to be done in mid to late October. So those are the two big picture things that I think if they're done in the next 30 days, then we have significantly reduced the possibility of any major systemic risk coming from LIBOR ceasing to exist. And it is very important, too, that I would say that one of the things that we worked on an awful lot on, and I want to credit ISDA here in particular, is the idea that we would have both a cessation trigger and a pre-cessation trigger. So what do they mean? All right, bottom line here is one of them worries about LIBOR itself going poof and going away. The other trigger, however, looks at a unique situation, which is some have termed zombie LIBOR, where you actually have LIBOR not going away, but still being there despite the fact that the FCA has declared it unrepresentative. So in other words, it's dead from a regulatory standpoint, but it's still alive from a market standpoint and the kinds of issues that would cause. So we wanted to make sure that when the ISDA protocol is out there and written, it allows both triggers to take place.
When we think about that all coming together, I'd have to say that even during this period, but over the last probably 6 months or more, all these work streams have begun to intersect. Whether that be the clarity and the consistency of message from the official sector, the work which even at the ARC, I would say, with the work that we've done at the Alternative Reference Rate Committee, I think we've been able to double our meetings. We've had access to our members in a very different way during this virtual environment. We've been able to release our set of best practices, which, gives market participants some guidance and very date-specific, product-by-product approaches to this. And we've also been able to, I think, where we can see all these things intersecting, because as we approach this, we've also put out a best practice, which, for the market to sign up to the ISDA protocol as soon as possible, for large participants to sign up in what is known as this 2-week escrow period from the point that it gets released. So again, I think what we're beginning to see, and as we approach, I think the way it was put by President Williams a few months back, entering the end game of this work as we get into the last year, is to make it really clear that from the ARC's perspective, from the Interest Rate Reform Subcommittee of the MRAC, and from the official sector and comments like we've heard from you today, that there's a clarity and an intersection taking place as we approach year-end 2020. And I think what we've heard from the FCA and the Bank of England and the Fed, CFTC, other official sector participants, it's really clear. So the ARC continues to provide tools to the market across not just derivatives, but cash products as well. ISDA has completed, I think, to your point as well, considerable amount of work in getting this protocol ready to go. So when we hear this and it combined with the comments giving us here today, I think it really leads us to a point where, we really can complete this work in the time allotted, and market participants, I think, you could really, remain focused on this as we've heard earlier today. But I know we need to leave a little bit of time for Q&A from the audience, but I just would want to pass to you for any thoughts that you may have for the next couple of minutes.
Sure. I would just say the parting message is exactly as you said, Tom. The public sector is actually ahead. The official sector, we've pretty much finished up our work with maybe a few odds and ends left, but that are not, particularly material from a systemic standpoint, which is great news. So you need not wait for the government. However, it'll work if you do. We need the private sector now to step in. And so what does that mean for private sector participants? First of all, I think each private sector institution should really think about its legacy risk and really understand, its exposure to LIBOR. I also think, as we've hammered home, really we would encourage you very much to sign up to the ISDA protocols when they're ready. And then finally, I think you've got to think about, well, what's the regulatory exposure for LIBOR assets that can be switched over to non-LIBOR it's going to be an issue, I think, and it could even lead to litigation. So there's a bunch of exposure that I think financial institutions really need to think about. And at the end of the day, I think we've given all the carrots we can give. And my concern is the only thing that's left are sticks. But the good news is you have time.
Thank you, Chairman Tarbert. I think we could go to Rania if there are any questions from the audience.
Great. Thank you both very much for the very engaging and lively discussion. At this time, if anyone in the audience would like to submit a question, if you haven't already done so, please feel free to do that in the question and answer box on the lower right-hand corner of your screen. I'll just give it a moment for people to have some time to submit their questions. It looks like we have one from the audience. The question is, can you comment a bit more on forward-looking term SOFR and how that impacts the market's transition?
Certainly. At the ARC, as you know, one of our key milestones is to deliver a forward-looking term SOFR, and this I think has been something that it's very important that we're able to clarify. As we heard from Commissioner Tarbert, the fundamental issue with LIBOR is this, I think, this inverse pyramid, right? Not enough transactions supporting too many financial contracts, and I think the goal here is that we can create a framework, and the ARC has put out an RFP for an administrator of a forward-looking term SOFR. This work has also happened in the UK for Sterling LIBOR and SONIA. But what we're finding now is that the important elements of this will actually be to ensure that we have enough transactions underlying this. We want to go back to first principles, and that's how we got here, by not having enough underlying transactions supporting too many financial contracts. So this, again, is a point where the ARC can deliver, create a framework and an administrator, but by no means would we be able to endorse something that had the same, sort of fault lines as LIBOR. So our goal here is to get the frameworks in place, get an RFP completed, but at that point, it then goes right back to the market, which is, unless we see more activity using in the derivatives markets, future swaps, it's going to be very hard for us to be able to endorse a curve. So again, I think along the similar lines that we've heard from Chairman Tarbert is there's so much the ARC can do, but there's a lot that has to go right back to the industry on this. And I think this comes down to when the derivatives markets move in earnest to SOFR, we believe that we'll be able to determine that we have enough transactions to deliver on that milestone, but it's a big dependency on the market.
Okay, great. Thank you for that. We do have another question from the audience. It says that how should market participants think about transitioning to a rate that does not bear credit risk?
I think that the best way to put this, and I know that there were some comments from Michael Held this morning on this, which people should refer back to, but I would say that the simple answer is that we at the ARC put together a rate that we believe is durable, ready now, IOSCO compliant, and will continue to be based on transactions through all market cycles. And the ability for market participants to use that rate, whether it be compounded in advance, compounded in arrears, overnight, we've seen in the floating rate note market, a lot of cash markets, certainly the derivatives market, the ability to actually compound is all there. So there are particular products and particular market participants who would like to see a credit add-on to SOFR. That work is taking place with the credit sensitivity group. But again, we're as I think we've heard at the very beginning here, is that we are working towards 12/31/21. So to the extent people can find rates that they can use that meet standards and don't have the same fault lines as LIBOR, the ARC doesn't discourage that. I think what we're trying to do is to say what's available today, and can people be thinking about actually how to use SOFR now, and to the extent those things happen after the end of 2021, that doesn't preclude people from using them then.
And I would just add, Tom, that I agree with you fully. From my perspective, the issue is how do we address the potential systemic risk of LIBOR going away, and the transition to an alternative rate, whether it's SOFR or whether it's other alternative rates. I think we remain neutral in that point, provided, as you mentioned, that whatever alternative rates are out there and that emerge don't have the same kind of problems that LIBOR had. But we're very much looking forward to a market solution we want vibrant derivatives markets. And so we certainly have no objection to additional alternative reference rates coming to the fore and being used. Our focus is really on making sure that when LIBOR goes away, we're not jumping into the sea. There's some kind of lifeboat there.
Okay, great. I think that wraps up this portion of the agenda today. So once again, thank you very much, Chairman Tarbert and Tom Wipf.